Okay, in this session, we're going to learn about ratio analysis. Now, the three key things you need to understand are the main three ratios. You need to understand how to calculate them and obviously what they show. And ultimately, we're going to use them to help determine how successful this business is performing. Now, before we get into ratios, think of it like this. You can look at the accounts of the business, like the profit and loss account, and there's lots you can learn from that. Like a scientist can look at the stars with their eyes, and there's lots they can determine from that alone. But sometimes you need another tool that helps you zoom in a lot closer to see things that you can't see just with your eyes. You need a telescope in science. Well, ratios are a little bit like that. They allow us to kind of zoom in and to really get a better understanding about how well the business is doing. Now, there are three ratios that you guys need to know. And whilst they sound fairly complicated and a little bit foreign in terms of the language that they use, remember again that we're not going to do anything more complicated than addition, subtraction, multiplication, division. All right. So with a little bit of practice, everybody can be confident and do well here. Right. Let's have a look first of all at these profit margin ratios. Very similar, aren't they? So what we have here is a ratio that says the gross profit margin is the gross profit divided by the sales revenue multiplied by 100. The net profit margin is the net profit margin divided by the sales revenue multiplied by 100. So these two are fairly easy to remember because they're basically the same ratio, aren't they? Now, obviously, what we're looking at here is this one tells us what percentage gross profit the business makes. And if I want to make a profit, I want to make the highest profit possible. This one here, net profit, well, of course, I want to make a maximum amount of net profit too, and this tells us what percentage net profit the business makes. Now, let's just remind ourselves for a second here. Remember where these figures come from. They come from the profit and loss account, and this is the one that we've used in the previous video. So let's quickly remind ourselves that this business, it makes monitors, sells £150,000 worth of monitors. It has to buy materials, screens, plastic, and has to pay workers to make those monitors. So it's cost it £100,000 to make sales of 150. What it's left with after paying for the supplies and paying the production workers is £50,000. It's got lots of general business costs that have to be paid no matter how many monitors are made. And we call these expenses and we add them up. And then £50,000 gross profit minus expenses leaves us with our net profit. So we look now at these two formulas. We can see the gross profit margin is £50,000, so it's the gross profit, divided by the sales, multiplied by 100 to make it a percentage. So we've got a gross profit margin of 33%. If we do the same for the net profit margin, net profit, which is 26,150, divided by sales revenue, 150,000, times by 100 again, tells us we're making a net profit of 17.4%. Now, a couple of things to note. Gross profit will always be a bigger figure than net profit. Why? Well, because gross profit only takes off the production cost, the cost of sales, where net profit is what you're left with after all of your costs are subtracted. So you'll always have a net profit figure that's smaller than your gross profit figure. What does that percentage mean? So the best way to think about it is this. Gross profit means that I'm left with 33% of my sales revenue after I cover my cost of sales. Net profit means I'm left with 17.4% of my sales revenue after I cover all of my costs. Okay? Now, just like in the last scenario, the exam board are likely to give you some data. So again, I've made a mini version of the profit and loss revenue minus cost of sales equals gross profit minus business expenses equals net profit. They're going to give you some data, and then what they might do is ask you questions about that data. So let's have a little practice run together. So calculate the gross profit and net profit margins, right? So gross profit in year one is 46.66%. Well, where did I get that from? So gross profit, remember, gross profit margin is gross profit 70 divided by 150 multiplied by 100. And that gives us 46.6% in year one and 37.7% in year two. Net profit margin is the net profit, this 30,000, divided by the sales figure, multiplied by 100. And that gives us a 20% in year one and 13.3%. So, how's the business doing? Well, I've put some analysis there to help us out a little bit now, but we can clearly compare the 2 years, can't we? We can see that the gross profit margin, worryingly, has decreased an awful lot. And almost as worrying, the net profit margin has also decreased. Not by quite as much, but also by a worrying amount as well. Something's not going well. So I've said here, let's put some words to it. Gross profit margin, this fell by 8.89%. So I've just looked at the difference between the 2 years, between 1 and 2 years. It's really bad news. Even though sales have increased, because we can see that, can't we? Sales have gone up. That's good news. For some reason, we seem to be paying a lot more in our costs. So look how much, even though sales have gone up, look how much costs have gone up by. And therefore, there's a problem. To fix this, we need to change supplier or get a better deal with the current supplier because we can't be paying this much for our supplies. Get this number down, or gross profit go up. Net profit's fallen by 6.67%. So you can see that's the difference between the 2 years. Again, this is also bad news. Well, why is this going on? Well, you can see here that the business expenses have shown a big increase as well, haven't they? Well, okay. So what are we going to do about that? Well, start having about what these expenses are. Can we cut down on wages and heating and lighting and advertising? Can we negotiate cheaper rents? Ultimately, if we get more money in, if we cut back on some of these costs where we can, then our profit figures rise. So even though overall the business is making the same amount of net profit, we're doing worse this year because our profit margins have gone down. We're having to make a lot more sales, aren't we, this year than last year, just to generate the same amount of profit. And that's what I meant at the beginning of the video about the telescope. Sometimes we need to look into the accounts with a bit more detail, things we can't just see with the naked eye. And that's what the ratios allow us to do. Okay, now that's 2 of the 3 ratios done. The final ratio is a little bit different. This one's called the average rate of return. Now, think of it like this. Imagine you've got some money, you've got £100, and you've got to decide, well, where should I put my money? What bank account? Bank account 1 gives you an interest rate of 5%. Bank account 2 would give you an interest rate of 1%. Well, of course, I'm going to put my money in bank account number 1 because that's going to give me the best return. Well, that's kind of what we're doing here. Often businesses have to decide whether or not something's a good investment. Should we do it or should we not? Or should I choose between doing 2 different things, right? So in this example, we've got a gardening business that spends £5,000 on a new ride-on grass mower. You know, you've seen these things, haven't you? You sit on the back of them and you can cut the grass really quickly. Quite cool. Now, it's going to cost £5,000, and every year we can see that it's going to allow this garden business to make some income. If we added up the 5 years that it's going to be in use for, the total amount of income it's going to make is £13,000. So it's going to cost us £5,000, but it's going to make us £13,000. Right, so what I can now do is start to work out the average rate of return. So there's a few steps involved in this, okay? And it's important that you practice this formula so you commit it to your memory. Okay, step 1, we need to calculate the profit. So we know, don't we, that profit is your total income, your revenue, take away your cost. So we've got 13 grand coming in, all the income, but it's cost us £5,000. So by buying this machine, we make a profit of £8,000. Secondly, I need to work out what does that profit look like each year. So what's the average profit? So we can see that it's going to be around for 5 years. So 8,000 divided by 5 gives me an annual average profit of £1,600. Now that's pretty good, isn't it? 5 years in a row is going to give us this on average when it's only cost me £5,000. So I'm pretty happy at the minute. Finally, I need to work that out as an average rate of return, a percentage that gives me what percent return do I get on my money each month, each year. So we can say then that on average each year it makes us £1,600 and it cost us £5,000. And I multiply by 100 to make it a percentage. And this tells me that I'm going to get, if I buy this machine, a 32% average return. Well, that's amazing, isn't it? Think of my two examples at the beginning. I have the bank account with 5% interest rate, the bank account with 1% interest rate. Well, they're both rubbish compared to this 32% return on investment, aren't they? I know where I would want to put my money, and it isn't in the bank. Now, what that ultimately allows you to do is to make comparisons between different things. I'll just jump back a second. Imagine if I've got a choice. One machine give me a 32% return, a different machine give me a 19% return. Well, therefore, I would go with the higher figure, wouldn't I? And it helps me decide between investments. Where is it best for me to put my money? Okay, finally then, what if they just give you a general question about ratios? Okay, why are ratios good? Well, they help you see how profitable a business is. They can help you measure the performance of a business. You can compare over time the different years and if your performance is getting better or worse. They can help you compare investments. But ratios are only as good as the information that's in them. If the information in is not accurate, then what we get out is also really poor. Just because something happens in the past, because ratios always look back in time, doesn't mean it's going to happen in the future. And if I just look at 1 year's worth of ratios, that's really limited. I need 2 or 3 years so I can see a pattern emerging over time. And then finally, the ratios might point me in the right direction, but I've still got to solve the problem myself. So if my profitability is not as high as it needs to be, what am I going to do about it? So overall then, ratios are really helpful. All businesses should use them, but you need to use them alongside other things, the manager's knowledge and the owner's skills, to really get a full understanding of how well the business is performing. And that is probably the most complex topic area in finance.